What's up, people? Welcome back to Invest with T-Claus. My name is Tevi, and this is a channel dedicated to my investment journey, along with coverage on Tesla, NIO, Virgin Galactic, and ChargePoint. Come for the information, stay for the fun clips. So another week has passed, and the tug of war between the market and the Feds continues with no signs of truly letting off in the near term. And if you wonder why that is, well, I think the commentary by Mohammed El-Arian here sums it up quite well.
Have you noticed that good news for the economy has turned out to be bad news for the markets? And it's a complete reverse of last year. And what reconciles all this is that bad news for the economy meant ample and predictable liquidity injections by central banks around the world. Now we're seeing increased dispersion among central banks around the world. And that is undermining what has been a very comforting liquidity paradigm. So that's why you've noticed, and others have noticed, that good economic news has become bad news for markets. And the transmission mechanism is the liquidity paradigm. There's less confidence in the robustness of a liquidity paradigm that has been incredibly helpful for assets.
So what Mohammed is getting at here is that the market has gotten very comfortable and has been relying on the injection of free money in the form of stimulus checks, as well as cheap to borrow money due to low interest rates. And so now with the economy reopening, there's this fear out there, and those forecasts are showing that inflation is going to potentially come in much sooner than anticipated. And so now this is creating two camps. You have those who believe that the Fed and Jay Powell are not being truthful and that they're going to be raising interest rates based on those forecasts much sooner than they have been communicating. And then because of that, that camp is now selling the 10-year bonds, as well as pretty much everything that has to do with growth and other treasury notes, and rotating that money into short-term investments that will benefit from the reopening, which are your cyclicals, financials, and just plain reopening plays such as cruise lines and airlines. On the other hand, you have those of us who believe that the Fed is not going to be raising interest rates based on the forecast, which is basically what they've been saying all along, that they're truly going to be waiting for actual inflation to get here before starting to adjust the monetary policy to account for that. And that's, again, not being anticipated until 2023. I think it's fair to say, based on everything that I'm seeing and reading, that there's a lot more people who can actually move the market in a meaningful way that are in camp number one. And so for that reason, I expect the 10-year Treasury bond yield rate to continue to rise steadily until we get to about 2 to 2.25%. At which point, again, based on everything that I'm seeing and reading, that it's probably going to settle somewhere around there. And so on the way there, I think there's going to be a lot of volatility, and there's also going to be periods of calm. But what I expect the market to do, and you know what? Actually, I'm just going to show you what I expect the market to do.
ほらほら照れるなよこっちまで恥ずかしくなる
Bet you didn't see that one coming. But that's Gojo from Jujutsu Kaisen. It's a new anime that I'm watching right now. And so Gojo is the most OP character in the series. He's the one with the bandana over his eyes. And he tends to lure his opponent in and gives them a false sense of confidence, and then just out of nowhere just utterly destroys them, right? So stick with me here. It's going to make sense in a second. The point that I'm trying to make is Gojo is the market. And as we're seeing the bond yield rate rise, slowly but surely, there's going to be those periods of calm where you're going to feel good, especially as a growth investor. You're going to see the NASDAQ rise. You're going to see some of those names start to pop up, and you're going to want to buy the dip, right? And move up, or throw, into some speculative names, throw some money at those. Just don't, right? Understand that the market this year is not what it was last year. You're not going to be able to just throw money randomly at just about everything and make money. You're going to want to be very selective on where you're putting your money, especially when it comes to growth stocks. Understand that moving forward, earnings and being invested in the right names will dictate the difference between success and failure. And so the market will favor and reward the winners based on their performance, and eventually over time rotate back into those names and push them up higher and higher. So frankly, the advice that I have for you at this point is befriend Gojo, understand him, and respect him. Let's get back to the video. Speaking of being selective with my investments, the focus of today's video is going to be on new price targets that were released for ChargePoint and Tesla. And in my opinion, those two are long-term winners, which is why I'm invested in them. Now, with that said, I'm not a financial advisor, so make sure that you do your own research before investing your cash. Once we've gone over those price targets and I've offered my opinion, we'll wrap things up with the weekly performance review expressed in percentages for the portfolio. All right, let's get into the video. All right, so kicking things off with ChargePoint, we now have 3 different analysts covering the stock, and each have issued their price target along with a rating, and those ratings, again, can be either buy, sell, or hold. And first up is going to be Craig Irwin from Roth Capital, and his price target is $46 with a buy rating. And his rationale, and before we get into the rationale, let's look at his tip rank profile. And we can see here that he's ranked 529 out of 7,398 analysts. And so his rationale for assigning that price target is that ChargePoint has a 73% share in networked level 2 EV charging stations, which he calls a good indicator that the company should remain a long-term leader in the rapidly expanding EV charging infrastructure market. EV market expansion, consistent with consensus forecast, could support material long-term upside. So nothing too unexpected here. These are pretty much some of the reasons that we've discussed on the channel before for why ChargePoint is going to be a long-term winner. Next up, we have Gabriel Dawood from Cohen & Co. and his price target for the stock is $43 with a buy rating. If we look at his tip rank profile, it's pretty poor, and he does not provide a rationale for why he selected the current price target that he has assigned. But on the flip side, I think this rating should help improve his odds and his ranking on tip rank. Last but not least, we have Colin Rush from Oppenheimer with a price target of $39 and a buy rating. And if you recall last week's video, that's the analyst that I was interested in hearing his price target for the stock. If we look at his tip rank profile here, he's ranked number 6 out of 7,398 analysts. And his rationale for selecting the stock is that ChargePoint posted solid Q4 results and guided ahead of the street for fiscal year 2022. Given a backdrop of strong EV growth across both passenger and commercial vehicles, we believe ChargePoint is seeing demand inflect higher. We are encouraged to hear commentary that utility-driven protocols and regulations are being refined as charging infrastructure density increases, and expect ChargePoint to be the key beneficiary of these programs given its modular design that enables smoother power management at a given location. We are also encouraged by momentum in the commercial fleet market, which we view as a multi-year growth driver. And again, nothing too surprising here. And you could tell from the earnings call that he was impressed by what he had heard, and this is reflected here. Now, switching over to Tesla, as their new, much anticipated price target from Kathy Woods and the folks at ARK Invest just hit this past Friday. And if you recall, Kathy and the folks at ARK Invest are famous for their call a few years back of $4,000 pre-split adjustment per share for the Tesla stock. And this, again, at the time was laughed at by the mainstream finance media as no one believed it. Now, fast forward, and earlier this year, at a price of $800 a share post-split adjustment, we've hit that target. So it's no surprise that everybody was anxiously waiting for this new price target. And so it is here now, and the new price target, the expected price target in 2025 for Tesla is going to be $3,000 with a 50% probability. In their bear case, at a 25% probability, they expect Tesla stock price to hit 1,500. And in their bull case, also with a 25% probability, they expect Tesla stock to hit $4,000 a share as the price target. And so some of the key assumptions that they've made to justify these new price targets that were just released are as follow, and I'm going to quote them. 1, we push our forecast price target forward 1 year to 2025. 2, we refined our estimates for Tesla capital efficiency. 3, we added Tesla insurance business to our model. 4, we added assumptions for a human-driven ride-hail service. 5, we increased the probability of Tesla achieving fully autonomous driving within 5 years. So even though the expected price target is $3,000, or you can think of it as $15,000 pre-split adjustment, which essentially would give them a market cap of around $3 trillion in 2025, and essentially make them more valuable by market cap than even Apple, and basically make them the largest company in the US and the world by market capitalization. What's really crazy to me is that they've gotten here without including these assumptions in their model. They did not include Tesla Energy residential storage or Megapack. Solar is not included. There was no assumptions of Bitcoin as part of their balance sheet. So all of those were not included in this. So you might be looking at these numbers and thinking to yourself, this is crazy, there's just no way. But think back a few years when they called the $4,000 a share and people, they didn't believe it. They sold out of their positions and now they regret it. So as far as I'm concerned, simple math tells you that 100 shares of Tesla at the current price is about $60,000. If we hit the $1,000 mark by the end of the year, that's 100K. And by mid-decade, if we hit that bull case, that's about $500,000 or so, or close to $500,000. So those are odds that I will take given Tesla's track record and their ability to execute and deliver on all of their promises. I'm more than happy to see all the fund managers and money managers focus on the near term, selling off tech and buying banks and cyclicals and all that fun stuff. It makes it cheaper for me to get more shares of Tesla. And that's basically what I'm going to keep doing. I'm going to double down, and when there's opportunity, I'm going to buy. Not financial advice, just what I plan to do. And knowing that that's likely where we're going, the future is bright for Tesla. All right, so let's wrap things up with a weekly performance review expressed in percentage gain or loss for the portfolio. And I'm going to turn on the screen recording here. And in my opinion, this week was marked by three major events. The first one was the jobless claim numbers coming in higher than anticipated. So that's the first decline that you're seeing here, to bringing us down to about 7.74%. The next one was right before the address from Jay Powell, and we bottomed out at 13.74%. And we saw the typical nice rise right after, where the equity market was happy that the Fed wasn't changing policy. But then the next day, the bond side of the market essentially realized what the Fed said, which was, we don't care about the forecast inflation. We want to see real data. Bond market didn't like that, sold off sharply, and then the bond yield rate went pretty much through the roof, post pre-pandemic level at 1.73 or so. And so that was reflected here in the sell-off of growth stocks and everything else. And we ended the week at about a loss of 7.98% on the portfolio overall. Not too mad at it if you consider that last week we were up by over 35%. So it's a nice little pullback, it's expected, and it offered some good buying opportunities. Now, keep in mind that not every dip moving forward is going to be a buying opportunity. But in this case here with Tesla at $650, couldn't pass it up, so picked up a few shares there. All right, people, this will do it for today's video. If you enjoyed the content and found it insightful, please drop me a like and share with your friends. Also, for my newcomers, consider hitting that subscribe button and ringing the notification bell so that you don't miss any future content. As a reminder, I post every Sunday and occasionally during the week. And as always, thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.